Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 438 on July 31st, 2026. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on T1 Energy, Sable Offshore Corporation, Mobileye Global Inc, and the iShares Ethereum Trust ETF, and we discuss 4 new trades on Keel Infrastructure Corporation, the Tradr 2X Long SNDK Daily ETF, American Airlines, and First Majestic Silver Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. And as a side note, I actually have not been checking the email for a little while. I've had my head down focused on some active trades. I've been actively trading energy again and managing a couple of other projects. So I'm trying to create some tools that'll be fun to share with the group and be able to give you guys a little bit more insight for your own trading. So I've had my head down working. I haven't forgotten about you. So if you've reached out and you haven't heard back from me, I promise it's coming. All right. So I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets moved roughly 1% higher this week. The Dow Jones Industrial Average gained 537 points, closing the week at 52,485 points. The S&P 500 index picked up 77 points, ending the week at 7,489 points. And now it's time for the topic of the week. The topic of the week is paying tuition. I was speaking to one of the people I coach on trading options recently. They had been on a consistent pattern of losing money. They made the joke that they were just paying tuition. I asked them the same question I will ask you. Are you paying tuition, or are you just losing money? What's the difference between those two statements? I'm glad you asked. Paying tuition means you are learning. It means that the money you spent was for the sake of learning a lesson. If you are not learning or improving your strategy, you're just losing money. If I have to lose money, I at least want to learn something from it. I want it to be tuition. There are a number of ways to learn from your mistakes. They all start with acknowledging that you're just losing money. From there, you can start to analyze your system and your processes for making trades. They either make money or lose money in the long run. They either have an edge or no edge, because we're always seeking a little bit of an edge that can be exploited in our trades. If you don't have either and you're losing money, you're just losing money. So remember, if you're not learning, then you're just losing money. Keep learning. Only pay as much tuition as you have to. All right, let's get into the review of last week's trades. We're going to start off with our covered call on T1 Energy, symbol T as in Tango, E as in Echo. At the time the stock was trading for $4.99 per share, I looked at buying stock and selling the August 5 call at 80 cents, hoping for a return of 16.23% in 4 weeks. Well, shares of T1 Energy lost 81 cents, ending the week at $4.18 per share. The call option we sold lost 40 cents, leaving us with a net loss of 41 cents if we were to close the trade out immediately. Now, the stock is 1 penny below the break-even point. Call me crazy, but I'm willing to let it ride on a penny for sure. This trade has 3 more weeks to go. We would not really get enough premium to justify altering the trade by rolling the strike lower at this point, so I'm choosing to not adjust this week and give this one a little breathing room. If it gives me more reason to adjust, I'll do so in the coming days. Remember, if you don't make an adjustment, it's okay. The call option would expire out of the money. We would keep the premium that we collected for selling the option, and then we would sell another call option against the stock next month, ideally increasing our total profit. So not a bad plan either way. I'm going to hold off. Next, we have our cash secured put on Sable Offshore Corporation, symbol S as in Sierra, O as in Oscar, C as in Charlie. At the time the stock was trading for $4.71 per share, I looked at selling the August 4.5 put at 57 cents, hoping for a return of 12.67%. Well, shares of Sable Offshore rose 58 cents, ending the week at $5.29 per share. The out-of-the-money put that we sold is still out of the money, so this trade is working out as planned, and because the trade is working out as planned, no adjustments are needed. Nice trade. Next, we have our credit spread on Mobileye Global Inc., symbol M as in Mike, B as in Bravo, L as in Lima, Y as in Yankee. At the time the stock was trading for $8.04 per share, I looked at selling the August 8 7.5 put spread at 18 cents. That could give us a maximum possible loss of 32 cents per spread. Well, shares of Mobileye lost 10 cents, ending the week at $7.94 per share. The out-of-the-money put spread that we sold is now at the money. The short strike, the August 8 put, is 6 cents in the money right now. So this is a spread that's worth watching. Now, the stock price is still above the break-even price, so the spread is still technically making money. We'd like to see the stock push higher a bit more, above $8 per share. For now, no adjustments are needed. We're still 12 cents above the break-even point. It's too soon to create the iron condor. That could actually lead to a loss if the stock was to rally higher, which is exactly what we wanted to do. So let's give this one a little room to breathe as well. And then our final trade from last week was the debit spread on the iShares Ethereum Trust ETF, symbol E as in Echo, T as in Tango, H as in Hotel, A as in Alpha. At the time the stock was trading for $14.03 per share, I looked at buying the August 13.5 14 call spread for 33 cents. With that would give us a maximum gain of 17 cents, or that's a 51.52% return in 4 weeks. Well, shares of the Ethereum Trust ETF inched 3 cents higher, ending the week at $14.08 per share. The in-the-money call spread that we bought is still in the money, and the stock is rising, and we are well above the break-even point right now. So as long as that remains the case, we're looking forward to a 51% return in 3 weeks. So no adjustments are needed at this point on the debit spread either. So that's it for the review of last week's trades. All new trades on today's show will continue to use the August 21st expiration date for monthly options in August. So let's get started with our covered call for this week. I'm looking at Keel Infrastructure Corporation, symbol K as in Kilo, E as in Echo, E as in Echo, L as in Lima. The stock ended the week at $3.98 per share. I'm looking at buying stock and selling the August 4 call at 45 cents. That could give us an 11.81% return in 3 weeks. Now you enter this trade by buying stock for $3.98 and selling the August 4 call at 45 cents. This trade makes the most money if stock prices finish above $4 per share. The break-even price on this trade is $3.53 per share. In real terms, the stock purchase will require $398 and you'll collect $45 for selling the option. Next up, we're looking at the cash secured put on the Tradr 2X long SNDK daily ETF. Symbol S is in Sierra, N is in November, X is in X-ray, X is in X-ray. The stock ended the week at $9.34 per share. I'm looking at selling the August 8 put at $1.55. That could give us a return of 19.38% in 3 weeks. Now you enter this trade by selling the August 8 put at $1.55. This trade makes the most money if stock prices finish above $8 per share. The break-even price on this trade is $6.45 per share. In real terms, you'll collect $155 for selling the put option, and you'll have $800 locked up in case you need to purchase the stock. Now, before we move forward, I just want to share a little bit more about this one. SNDK has been in the news, and you might think I'm crazy for looking at selling a put on a stock that was down today, down 10%. But if you look at the fact that the stock closed today at $9.34, and I'm selling the August 8 put, that's another $1.34 lower that this stock could go before we even start to worry. The other thing about it is if I have to buy this stock for $8 a share, right? Which is what will happen. That's the other side of that cash secured put. You actually end up having to buy the stock. I would keep the $155. So that means that my break-even price, right, is $6.45. That is a full 20, that's almost a third lower of where the stock is right now, right? So this stock has to go down 30% for me to really start losing money on it. Plus, if I get the stock, I'm going to look at selling a covered call on it immediately. And those are also trading at a phenomenal price. So overall, if you can collect on this stock for 2 to 3 months in a row, like assuming that you lose money this month, losing money meaning you have to buy the stock as well. If you collect on this stock 3 or 4 additional months, then this stock is going to be free. And if they make a change where SNDK does push higher, then you're going to see a lot of good stuff. So I normally don't explain a trade like this, but I had to look at it myself and I went back and forth and I finally just said, no, the premium makes it worth it. And the fact that the stock is under $10 per share is great. I'm willing to risk $800 to make $155 this month. So that's kind of how I think through this. Let's get back to the show as we normally broadcast. So next we have our credit spread on American Airlines, symbol A as in alpha, A as in alpha, L as in Lima. The stock ended the week at $15.27 per share. I'm looking at selling the August 15, 14.5 put spread at 16 cents. That could give me a maximum possible loss of 34 cents per spread. Now you enter this trade by selling the August 15 put at 53 cents and concurrently buying the August 14.5 put for 37 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $15 per share. The break-even price on this trade is $14.84 per share. In real terms, you'll receive $16 per spread that you sell and have $34 at risk. And our final trade on the week is going to be a debit spread on First Majestic Silver Corporation, symbol A as in alpha, G as in golf. The stock ended the week at $15.03 per share. I'm looking at buying the August 14.5, 15 call spread for 32 cents. That could give me a maximum gain of 18 cents, or that's a 56.25% return in 3 weeks. Then you enter this trade by buying the August 14.5 call for $1.25 and concurrently selling the August 15 call at 93 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $15 per share. The break-even price on this trade is $14.82. In real terms, you'll pay $32 to enter the spread, and your maximum gain is $18 per spread. That's it for today's show. Thank you guys so much for listening. Hope you have a fantastic weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.